What if I told you that a single decision in 1971 changed the value of money forever, triggered decades of inflation, and reshaped the global economy in ways still felt today? On August 15th of that year, President Richard Nixon announced that the US dollar would no longer be convertible into gold, effectively ending the gold standard. Overnight, the world's reserve currency was no longer backed by a tangible asset, and the ripple effects would echo through every corner of finance. But here's the question. Was abandoning the gold standard a bold move that saved the modern economy, or a mistake that set us on a path to endless financial instability? At the time, the price of gold skyrocketed in response, more than tripling over the next 5 years. By another measure, the US dollar lost more than 2/3 of its purchasing power against gold. Many economists consider this move the starting point for the economic turbulence of the 1970s and 1980s, a period defined by high inflation and volatile markets. Today, as global economies once again face rising inflation and geopolitical uncertainty, it's worth asking, was abandoning the gold standard really a mistake? The gold standard, as it existed up to 1971, was initially codified under the Bretton Woods Agreement of 1944. This system was designed to stabilize the post-World War II global economy. Under Bretton Woods, all participating countries pegged their currencies to the US dollar, and the dollar itself was pegged to a fixed amount of gold, $35 per ounce. This system indirectly tied other currencies to gold, ensuring a degree of international stability without requiring every country to maintain massive gold reserves. Importantly, only foreign governments could convert dollars into gold. Regular Americans could not. On the surface, this system seemed ideal. It promoted global trade, reduced currency volatility, and positioned the US dollar as the preeminent global reserve currency. But the system also carried significant drawbacks. A fixed currency, while stable, removed a natural shock absorber from the economy. Normally, if an economy suffers, its currency loses value, boosting exports and helping to stabilize domestic industries. Conversely, a booming economy would see its currency strengthen, allowing investment abroad. Under a gold-backed dollar, these self-correcting forces were constrained. By the late 1960s, the system's weaknesses became glaringly apparent. The US had accumulated massive deficits due to the Vietnam War, expansive social programs, and other domestic spending. Normally, such deficits would have devalued the dollar in foreign exchange markets, helping to balance trade and incentivize exports. But with a dollar pegged to gold and other currencies, this natural adjustment couldn't occur. Countries, especially France, began converting their dollar reserves into physical gold, draining US reserves. By 1971, it was clear that the US did not have enough gold to sustain the system indefinitely. Faced with this crisis, Nixon suspended the dollar's convertibility into gold, turning a temporary measure into a permanent shift. So, what are the benefits of the gold standard, and why do some economists still argue for its return? Perhaps its most significant advantage is stability. A gold-backed currency limits reckless money printing. Governments cannot inflate the money supply at will because each unit of currency is tethered to a finite, tangible asset. This provides a built-in safeguard against runaway inflation, preserving the purchasing power of savers over the long term. Another advantage is predictability in international trade. Gold is universally recognized, divisible, and fungible. When two countries trade under a fixed gold standard, they can conduct transactions without worrying about rapid currency fluctuations. In theory, this makes trade easier, reduces risk, and eliminates the need for constant currency speculation. The system also limits what economists call financial repression, situations in which savers are penalized by interest rates that fail to keep up with inflation, effectively transferring wealth to borrowers. Under a gold standard, governments have less flexibility to engineer such transfers, making it harder to inflate away debt. Yet, despite these benefits, the gold standard has serious limitations, many of which became apparent in historical practice. One major problem is rigidity. A country's monetary policy is largely dictated by its gold reserves rather than the needs of its economy. If a country's economy grows but its gold reserves remain static, it can experience deflation, constrained liquidity, or slower economic expansion. Similarly, interest rates may be forced to rise or fall based on gold availability rather than economic conditions. During the Great Depression, for instance, adherence to gold standards in Europe and the US exacerbated economic contractions, limiting central banks' ability to stimulate recovery. Gold is also distributed unevenly across the globe. While countries like the US, China, Australia, Russia, and Ghana produce significant amounts, many nations would struggle to maintain a full gold-backed system without acquiring massive reserves from others, a process that could destabilize international relations or lead to unsustainable trade imbalances. Even fractional reserve gold standards, where only a portion of money is backed by gold, carry systemic risks. If participants lose confidence in the system and attempt to convert large amounts of currency into gold simultaneously, the system can collapse, similar to a bank run. Another key issue is the opportunity cost of tying an economy to gold. A modern economy requires a flexible money supply to facilitate growth, credit, and investment. Under a strict gold standard, the money supply cannot expand in line with economic growth, potentially slowing development, discouraging investment, and restricting innovation. Historical data reinforces this. From 1951 to 1971, when the US was on the gold standard, the economy roughly tripled in size. In contrast, from 1971 to 1991, under a fiat system, the US economy grew six-fold, despite facing major challenges like the oil shocks of the 1970s and rising global competition. Clearly, unrestricted monetary policy enabled growth that would have been difficult under gold constraints. Critics of the gold standard often cite the 1970s inflation as evidence of the system's demise, but correlation does not equal causation. The high inflation of that era resulted from multiple factors: pent-up post-war inflation pressures, loose fiscal policy, the Vietnam War, low interest rates, and skyrocketing oil prices. Most economists agree that abandoning the gold standard was not the direct cause of this inflation. Instead, leaving the gold standard gave the Federal Reserve the flexibility to respond to economic shocks, a capability that was impossible under a rigid gold framework. Fiat currency systems, while dependent on trust rather than tangible assets, provide central banks with tools to maintain stability. Interest rates can be adjusted to influence borrowing and spending, and in extreme cases, asset purchases can inject liquidity into the economy. The Federal Reserve, for example, has successfully navigated multiple crises, including the 2008 global financial crisis and the economic disruptions of the COVID-19 pandemic, using these tools. While not perfect, fiat systems offer adaptability and scalability that a gold standard cannot match. Even the value of gold itself is based largely on perception. Yes, it has industrial uses, and yes, it is aesthetically valued, but its worth ultimately stems from collective belief in its scarcity and utility. A currency tied rigidly to gold is not immune to human psychology or global speculation. In contrast, a fiat currency allows governments and central banks to respond dynamically to crises, ensuring that money supply aligns with economic growth, demand, and inflationary pressures. Moreover, a gold-backed system would create significant global inequalities. Only a few nations control the majority of gold production, giving them disproportionate influence over the global economy. Countries with limited gold reserves would face severe constraints on monetary policy, potentially triggering trade imbalances, deflation, or social unrest. The practical challenges of reintroducing a gold standard today are immense, ranging from valuation disputes to logistical issues in gold storage and international trade. In short, while the gold standard offers theoretical benefits like price stability, predictability in trade, and protection against reckless monetary policy, it comes with profound limitations. It restricts economic growth, limits monetary flexibility, creates geopolitical imbalances, and offers little practical protection against inflation beyond long-term averages. Historical evidence suggests that fiat currency, while dependent on trust, provides far greater flexibility to navigate the complexities of a modern global economy. So, was dropping the gold standard a mistake? On balance, history shows that while it removed a layer of nominal security, it unleashed the flexibility necessary for economic growth, innovation, and crisis management. The challenges of the 1970s were less a consequence of leaving gold behind and more a result of fiscal, geopolitical, and energy pressures. Today, as inflation and global uncertainty loom, the tools provided by a fiat system remain invaluable. Without them, central banks would be powerless to respond effectively to crises, economic shocks, or recessions. Ultimately, the gold standard can be thought of as training wheels, useful in certain situations but too rigid to accommodate the complexity of a modern, dynamic economy. Fiat currency, backed by effective policy and robust institutions, allows economies to grow, adapt, and innovate in ways that a fixed gold supply never could. While gold still holds value as a hedge, a commodity, and a store of wealth, it is no longer the backbone of global economic stability.